Hi, I'm Will Maskowitz from Heartland Funds.
Hi, it's Will from Heartland. I'm here in Mondovi, Wisconsin. Hi, I'm Will from Heartland. I'm in California.
Hi, I'm Will from Heartland and I'm in Montreal.
Hi, I'm Will from Heartland and I'm in Texas.
Hi, I'm Will from Heartland and I'm in Milwaukee.
Hi, I'm Will from Heartland and I'm in New York City.
Hi, I'm Will from Heartland and I'm in Chicago.
Hi, I'm Will from Heartland and I'm in Alabama.
Hi, I'm Will from Heartland and I'm back in Milwaukee.
Hi, I'm Will from Heartland and I'm on PTO, fly fishing for smallmouth bass with my brother in northern Wisconsin.
Hi, I'm Will from Heartland and I'm at our office here in Milwaukee on our patio. It's not really patio weather, but I thought it'd be a good spot to shoot this month's video because we're celebrating the 1-year anniversary of this video series. And a year ago, I was on the lakefront with the Milwaukee skyline as the backdrop, and I thought a different vantage point would be kind of cool. Right over my shoulder behind me here is the city's City Hall, which was completed in 1895. It's a beautiful building. There's been a lot of restoration work in that facility over the last several years. For this month's video, I wanted to revisit some of the predictions that I made over the course of the last year, some good, some bad, but I don't really want to highlight necessarily the good. I'll touch on those and the bad, but really want to bring to life our culture because we have a motto here of constant, never-ending improvement, and revisiting past decisions, particularly on the investment side, helps us learn from those mistakes and also learn from the winners. So let's get through them. In November of last year, I suggested that the real estate sector might be a good place to be. The broader REIT group eked out a small gain versus the Russell 3000 Value Index, so a so-so call. What was not a good call was my forecast in December that the trucking space would be an attractive area in 2025 as the economy improved. The economy improved, but the truckers really struggled. It was an abysmal forecast on my part because there's just too many trucks on the road and not enough freight, so pricing power wasn't there. Where we did see pricing power was in my forecast in January for the refineries. As crude production continued to rise, demand remained resilient, and the refiners saw better crack spreads, which enhanced their margins. The stock worked quite well like we thought it would versus the broader energy sector. In February, I touched on the credit markets and suggested that credit spreads, particularly for high-yield debt, were unusually low. And given that there were a lot of uncertainties around the economy, with the tariffs coming, et cetera, that we thought credit spreads would work higher, and that has been, in fact, the case. And that's a good springboard in my forecast, I guess, for 2026, or at least one of them. In March of this year, we talked about the importance of free cash flow. One of our 10 principles of value investing is price to cash flow. We utilize free cash flow to see if the investment's attractive. We think free cash flow obviously allows for businesses to create their own destiny, if you will, buybacks, dividends, M&A, et cetera. But alpha-generating factors like free cash flow and profitability really have been overshadowed by massive speculation in the marketplace. And I think this deserves some additional color. Since the April lows associated with the Liberation Day tariffs, the Russell 2000 Value Index is up just over 30%. Companies in that index that have no sales are up 150% plus. So businesses with no sales are up 150%, while the broader small cap value market, as measured by the Russell 2000 Value, is up 30% plus. Quite remarkable. It's not uncommon to see lower quality businesses outperform in the early stages of a bull market. But the scope and severity of the rally in lower quality businesses or business with no sales or the non-earners has been quite strong, really off the charts. And our follow-up to this video on the web will touch on this in a little more detail. So when I think about a forecast for 2026, there's no doubt in my mind that we'll more than likely see a reversion to mean where lower quality businesses lag those that have better fundamentals associated with them, more profitability, better returns on capital, et cetera. And I really think that calls out the importance of being active. You referenced earlier credit spreads going higher. That still seems to be the trend. You referenced the amount of speculation in the marketplace. Here you can look at things like margin debt too that would corroborate that view. And this idea that investors are just very focused on small areas of the market. I touched on in the past in terms of AI and power, et cetera, and perhaps investors missing out on some great opportunities that are undiscovered, if you will. Looking forward to updating you more on some thoughts for 2026 as we close out this year and enter 2026. Thanks for watching and take care.